Imagine stepping into a world where one wrong move could lead to a disastrous outcome. Welcome to the world of investing, a thrilling universe teeming with opportunities yet fraught with pitfalls, where fortunes can be made or lost in a heartbeat. It's a place where the bold thrive, but only if they're armed with the right knowledge. Here, mistakes aren't just costly, they can be deadly. But fear not, because knowledge is power, and we're about to arm you with the insights you need to navigate this perilous landscape. We've identified 12 deadly investment mistakes that you must avoid to ensure your journey is a successful one. But that's not all. Stick with us till the end, and there's a bonus waiting for you. A precious nugget of wisdom that could be the difference between success and failure in your investment journey. So are you ready to uncover the 12 deadly investment mistakes you must avoid? Let's dive in. First up on our list is the deadly mistake of lack of diversification. Now, imagine a scenario where you place all your hard-earned money into a single company's stock. It's a risky move, isn't it? It's like betting all your chips on a single number in a game of roulette. If that company tanks, so does your investment. This is why diversification is key. Diversification is all about spreading your investments across a variety of assets. Think of it as a financial buffet. You don't just fill your plate with one dish, right? You try a little bit of everything. That way, if one dish doesn't suit your palate, the others might. Similarly, in investing, if one sector or company doesn't perform well, others might. It's about balancing the risk. Investing is not a sprint, it's a marathon. It's about long-term growth, not quick wins. And diversification helps you achieve that. It's like creating a safety net for your investments. If one falls, the others are there to catch it. So don't put all your eggs in one basket. Spread them out. Invest in different sectors, different companies, even different countries. Remember, diversification is not just a strategy, it's a necessity. Next on our list is a mistake that many investors make, neglecting asset allocation. But what does this mean? Picture your investments like a well-balanced meal. You wouldn't fill your plate solely with potatoes, right? You'd likely have some protein, veggies, and yes, a bit of your favorite dessert too. This is the concept behind asset allocation. Your portfolio should be a mix of different types of investments: stocks, bonds, real estate, commodities, and the like. Each of these food groups behaves differently in various economic conditions. By diversifying your portfolio, you spread the risk and increase the potential for returns. But here's the catch. It's not just about diversifying, it's about doing it strategically. Your asset allocation should align with your risk tolerance and long-term financial goals. And remember, it's not a set-it-and-forget-it thing. As market conditions change and as you age, you'll need to rebalance your portfolio to maintain that perfect mix. So, keep your eyes on asset allocation, not just the individual securities. The third deadly mistake is something we all might have been guilty of: chasing returns. It's a common misstep, an enticing trap that can ensnare even the savviest among us. Here's why. When we see a hot stock or a booming sector, our instinctual reaction is to jump on the bandwagon, hoping to ride the wave of success. But this approach is akin to driving while only looking in the rearview mirror. Sure, a stock or sector may have delivered spectacular returns in the past, but that doesn't guarantee future performance. The market is a fickle beast, and what goes up can, and often does, come down. So when we chase returns, we're making decisions based on past performance, not future potential. Instead, focus on long-term performance. Consider the fundamentals, look at the prospects, diversify, and remember, patience is the key. It's like planting a tree. You don't get to enjoy the shade the day you plant the seed. It takes time. In the end, chasing returns is like chasing a mirage. It might look promising from afar, but by the time you get there, it often vanishes into thin air. Don't be a return chaser, be a smart investor. The fourth deadly mistake is not having a disciplined investment plan. Picture this. You're out at sea, but you've got no map, no compass, no clear direction. That's what investing without a disciplined plan is like. It's floating aimlessly in a vast ocean of market trends, hoping to stumble upon treasure. But successful investing is not about luck, it's about strategy. It's about setting clear, attainable goals and creating a solid plan to reach them. It's about understanding the risks and rewards and knowing how to balance them. It's about sticking to that plan, even when the market gets rough. Because let's face it, the market will get rough. It's not a matter of if, but when. And when that happens, a disciplined investment plan will be your guiding star, your safe harbor in the storm. Without discipline, you're not investing, you're gambling. Let's speed things up a bit and look at the remaining 8 deadly investment mistakes. Fifth on our list is not investing in financial education. Just like any other field, investing requires knowledge and skills. You wouldn't expect to play a piano concerto without learning music, so why step into the investment arena without understanding the basics? Spending time and money on financial education is not an expense, it's an investment in itself. Without it, you're like a sailor setting off to sea without a compass. The sixth mistake is letting emotions guide investment decisions. Investing is not a game of emotions, it's a game of logic. When you let your emotions rule, you're likely to buy high when everyone is euphoric and sell low when everyone is panicking. Remember, fear and greed are poor advisors. Instead, stick to your investment plan and make decisions based on facts and figures, not feelings. Next up, the seventh mistake, not understanding the investment. Before you invest a penny, make sure you understand what you're investing in. What's the business model? How does it make money? What are the risks? If you can't explain it in simple terms, you probably shouldn't be investing in it. The eighth mistake is falling for get-rich-quick schemes. There's no such thing as a free lunch in the investing world. If something sounds too good to be true, it probably is. Real wealth is built slowly over time through smart and consistent investing. The ninth mistake is ignoring fees and costs. These can eat away at your returns over time, making a seemingly good investment a poor one. Always factor in the cost of your investments and look for low-cost options whenever possible. 10th on our list is not rebalancing your portfolio. This is a process of realigning the weightings of your portfolio of assets. Rebalancing involves periodically buying or selling assets in your portfolio to maintain an original or desired level of asset allocation or risk. The 11th mistake is not having a long-term perspective. Investing is not about making a quick buck. It's about building wealth over time. Be patient and let the magic of compounding do its work. And finally, the 12th deadly mistake, not having an exit strategy. Before you invest, know when and under what circumstances you'll sell. Having a clear exit strategy can help you avoid holding onto an investment for too long or selling too soon. Avoid these mistakes and you'll be on your way to successful investing. Let's take a minute to recap these 12 deadly investment mistakes. First, we dove into the dangerous world of investing, highlighting the risks and rewards. Then we examined the peril of lack of diversification, reminding you not to keep all your eggs in one basket. We warned against neglecting asset allocation, emphasizing the importance of distributing your investments across different asset classes. We also cautioned about the trap of chasing returns and the need to avoid being swayed by short-term market trends. Next, we underscored the importance of a disciplined investment plan, advising you to stick to your strategy, rain or shine. We then took a deep dive into the remaining deadly mistakes, from failing to anticipate variability in returns to ignoring the importance of financial education. We've walked you through these mistakes not to scare you away from the stock market, but rather to arm you with the knowledge you need to navigate it successfully. Remember, avoiding these mistakes is key to your investment success. As promised, here's a bonus for those who watch till the end. The secret to successful investing, the golden key that unlocks the treasure chest of financial freedom, is not a quick fix or a one-time strategy. It's a continuous journey of learning, adapting, and staying updated on market trends. Many would have you believe that successful investing is about picking the right stocks or timing the market perfectly. But the truth is, it's much more about understanding the principles that guide the market and adapting your strategies to align with these principles. Think of investing not as a sprint, but a marathon. It's not about the short bursts of success, but the long-term gains that come with patience, discipline, and the right knowledge. It's about understanding that the market will have its ups and downs, and the key is to stay the course, adjusting your strategies as needed, but never losing sight of your ultimate financial goals. Continuous learning is the bedrock of successful investing. It's about expanding your knowledge base, staying updated on market trends, and understanding how different factors can affect your investments. It's about learning from your mistakes, and yes, even from the mistakes of others. Remember, in the world of investing, knowledge truly is power. The more you know, the better equipped you'll be to make informed decisions that can help you grow your wealth over time. So keep learning, keep growing, and keep investing. Because the journey to financial freedom is not a destination, but a continuous process of learning, adapting, and growing. That's it. Like and subscribe for more financial information, and don't forget to check out some of my other videos. Happy investing!